Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Carnival stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Carnival is one of the world's largest travel companies. In February of 2022, it had 71% capacity compared to 0% in February of 2021. The company is headquartered in Miami, Florida, and was founded in 1972. The ticker trades on the New York Stock Exchange, Mexican Bolsa, Deutsche Börse, Sao Paulo, and London Stock Exchange. Let's get started with the model. This is a large cap company, 12 billion market cap. They're trading at $12 a share, and they have 990 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They did have a small amount of free cash flow in 2019, but then COVID hit and they had a huge negative in 2020, 2021, and the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that was positive in 2019, big negatives after that. Revenue is a sales for the company, and they had nearly 21 billion in 2019, 5.5 billion in 2020, below 2 billion in 2021, but it is improving. It's at 3.5 billion in the trailing 12 months. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that's positive 8 billion in 2019, negative after that. Below that is our operating expenses. These are all the expenses not directly related to generating the revenue. Gross profit minus operating expenses gives you your operating income, and that was around negative 7 billion in 2020, 2021, and the trailing 12 months. They spent about 1.6 billion of interest on their debt. And then other income and expenses. These are all the gains or losses not part of the company's core operations. Their pre-tax income, their taxes, and the bottom line of the income statement is their net income, which is about negative $10 billion the past 2.5 years. This is the company's latest income statement from their most recent 10Q. A little more than half their revenue comes from ticket sales. The other half comes from selling things on board, like alcohol. They pretty much had no revenue in the 3 months ending February 2021. Now they're at 1.6 billion. Here's a breakdown of their expenses. 250 million in commissions and transportation expenses, 200 million of onboard expenses, $500 million of payroll, 365 million of fuel, 136 million of food, and 557 million of other. Their operating loss is 1.5 billion, which is similar to last year. And their loss per share is $1.80. Now it's $1.66. The reason their loss per share is a little better is because their net loss is a little lower compared to last year, plus they have more shares outstanding. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates or loses from its operational business. In 2019, they generated 5.5 billion of cash flow. In 2020, it was negative 6 billion. It's getting a little better. It's about negative 4 billion in the trailing 12 months. And they spend a lot in CapEx because every time they purchase a ship, that goes into CapEx. They spent 4.6 billion in the trailing 12 months. Operating cash flow minus CapEx gives you your free cash flow. Since they have big negatives, they've been adding lots of debt. In 2020, they added 15 billion of debt, paid down 1.6 billion. So they increased their debt load 13.5 billion in 2020. They increased it about 7 billion in 2021, and they increased it about 5 billion in the trailing 12 months. They're also issuing more capital stock to pay their bills. They issued 3.2 billion in 2020, 1 billion in 2021. Every time a company adds common stock, it increases the shares outstanding and it makes your shares less valuable. Let's look at the capital structure. 10 billion of equity, 36 billion of debt. They're 22% equity, 78% debt. And their net debt is 29 billion. This is their capital structure since 2015. And you can see their equity balance was higher than their debt balance up until 2020. Then COVID hit and they added a lot of debt. Now their debt balance is a lot higher than their equity balance. Plus, they have a lot more cash on their balance sheet than before COVID. And I gave them the highest whack on Finbox, 16.5%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $34 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $18 billion. We divide that by 990 million shares. And we get a calculated stock price of $18. They're trading at $12, so they're trading at a 36% discount. It's a buy according to the model. The last time I looked at this stock was in November of 2021. They were trading at $18. My valuation was $15. And you could see the stock has decreased about 40% since then, but my valuation has come up a little bit, mainly because cruise lines are doing better and better each quarter. The company's revenue forecast in 2024 is $25 billion. In 2023, it's $22 billion. In 2022, it's $15 billion. And I continue this growth into 2025 and I got $27 billion. That's how I got their future revenue estimates. The average company in their industry converts 17% of their revenue into free cash flow. So I multiplied their revenue by 17%. That's how I got their future free cash flows. And I just assumed they would have negative free cash flow in 22 and 23 to be conservative. Simply Wall Street's valuation is $30. They're saying the stock is 57% undervalued. 9 analysts priced this stock and the average price target is 21, the low is 15, the high is 30. This is where the stock has been trading the last 5 years. It was over $70 a share in the beginning of 2018. Then before COVID, it was over $50. Then obviously the stock crashed a lot when COVID hit. It did increase a lot to over $30, but you can see the stock is down about 60-65% from that point. They have a pretty high beta, 2.03, so the stock is volatile. It moves 2 times the market. It's gone down 54% in the past 52 weeks, while the S&P is down 5%. The 52-week low is 12, the high is 32. And the stock is trading below its 50-day and 200-day moving average. And this is a really popular stock. 40 million shares are traded each day. 53% of the shares are held by institutions and 13% of the shares are shorted. They've done 2 2-for-1 stock splits, one in 1994 and one in 1998. If you invested $10,000 into this company 10 years ago, you'd have $5,200 today. That's a 48% loss, a 6% annual loss. The CEO's annual salary is $1.5 million and their total compensation is $15 million. In the past 12 months, there's been some insider selling, no buying, a sell for 96,000 shares, one for 7,700 and one for 12,000. 57% of the company is held by institutions, 32% by the general public, 11% by insiders, and a really small percentage by private companies, the government, and public companies. You can see their employee count peaked right before COVID at 150,000, but then it's gone down a ton since then, since there's not much activity. They're currently at 40,000 workers. The chairman of Carnival owns 11% of the company. The next biggest shareholder is Vanguard, then BlackRock, the Saudi Arabian government, and then BB&T Bank. Let's look at their financial ratios. We can't look at the PE since they have negative net income. They have a decent price to sales of 3.3, that's stock price of a sales per share. A really good price to book since they have lots of fixed assets on their balance sheet. The fixed assets are the ships. That's stock price of a book value per share. And we can't look at their price to free cash flow since they have negative free cash flow. They could cover 70% of their current liabilities with their current assets. Same thing with the quick ratio, 0.7. In the trailing 12 months, they had negative $8.4 billion of free cash flow. They have negative $2.9 billion of working capital. So it looks like they're going to be short. So they're going to need to add some debt or equity over the next 12 months just to run their business. The best way to look at ratios to compare them to companies in the same industry. There are 14 companies in the same industry as Carnival, and Carnival spends the most in CapEx of all the companies. They have a worse debt to equity ratio. They have the worst free cash flow of all the companies. They rank 6th in market cap at $11.7 billion. The average is $17 billion. They are doing better in price to book and price to sales, but we cannot look at their PE or price to free cash flow. They do generate more revenue than the average company. Their 5-year revenue growth rate is negative 27%, and they have a really bad ROA and ROE. So to summarize, I have them trading at a 36% discount, but it's been more than 2 years since COVID started. And finally, the cruise line industry is showing signs of improvement. But who knows when the stock will recover, because now we're in a pretty deep bear market. I rank their free cash flows 1 out of 10, their revenue 3 out of 10, and their ratios 3 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.